my colleagues are doing, so we can do that there. As I said, always I try to sort of cover on a bit of the hard skills and the soft skills. The hard skills are like, the sort of the trade setups, which everybody loves. Things like engulfing candles, star formations, key reversals, pin bars, but also soft skills. Okay, soft skills which maybe new traders don't realize, how important they are until you've traded for a while. Okay, and this is things like basically preparing yourself, to be able to make the most of opportunities, about managing risk. It's about having checklists, about reflecting and reviewing your trades. It's about grading your trades. All of these things, as I say, completely new traders sometimes miss. They don't really understand. But the reality is, the longer you trade, the more you'll realize these are the sort of things that become very, very important for us. So, as always, as a kind of say to everybody, is that we started off with trying to define 10 very simple steps that new traders could see when they're actually working on the chart. So, and actually, what we're seeing is that we have the 10 steps. Okay, first 5 I always go over every week, namely that. Part of it is just having a very simple checklist. All right. So whenever you open a chart, whatever it is, Bitcoin, euro, dollar, gold, whatever it is that you particularly look at, first thing you should be doing is defining levels of support and resistance. Okay, start with the monthly, go down to the weekly, down to the daily. Draw in those levels where we see that there has been prices either been rejected from, or prices basically consolidated at, because markets remember these levels and they can be very, very useful to us going forward. Step 2 is when we're looking at that chart, we want to define, is there a trend? Remember, I say it every week. Good trends leap off the chart at you, okay? Don't force it. You don't need to do that. You just have to realize that markets only trend 20 to 30% of the time. But what we're interested in is, well, if it is trending, well, what we want to be able to do is, in an uptrend, we want to be able to buy at levels of support. And in a downtrend, we want to be able to sell rallies at levels of resistance. So it's step 3. We're looking to see, how does price react at those particular key levels? And in particular, step 4, we're looking to see, does price print any price action triggers at those significant levels? Things like what we've covered: pin bars, engulfing candles, star formations, key reversals, etc. And then also take a moment to recognize, is it part of a bigger chart pattern? All right. Sometimes, traders and new traders, they get very, very narrow in their focus. They're really, supremely keenly focused on trading the next pin bar, etc. But actually, what we want to see is, sometimes we lose track of it. Okay, we can't see the wood for the trees, and we want to be able to step back and see, hang on a minute, is this part of a bigger chart pattern? Maybe it's a flag pattern and an uptrend. Maybe we're, trading into a double top as part, that's part of a market reversing. We want to be able to see, as I said, that you want to be able to see the wood for the trees. It might be that it's providing another opportunity to add to your trade, or it's just good management in terms of understanding the context of where this trade appears. Okay, so I'm just changing this. Hopefully you're able to. Hopefully, I'm hoping you can see me. I appreciate that lots of people, it helps them and stuff. So we can go with that, I hope. So and what we also talked about is what instruments do we want to focus on? Right, and we've talked, there's an awful lot of instruments, and we've done individual sessions on different asset classes. I normally say to people, dollar index, and then about 28 of the major crosses, the major and minor crosses. Look at the major global indices, the major commodities markets, some of the major equities, some of the big US tech stocks which move nicely. And I appreciate we have traders here who will also trade crypto. That is a bit of a broad basket. It's a bit of a broad spread. But what I say is, you can start off with this, but then actually, as you start to get a little bit of experience, as you find a little bit of your own particular groove, your own particular style, what you'll find is that will probably focus its way down to somewhere between 2 to 6 instruments. That's what I tend to find when I work with traders. Okay, they might have a broad spread, but they will find that there will be a few that they particularly focus on, or a few instruments that resonate with them, or that they work with really well. That's absolutely fine. So you can start wide and then actually just narrow down as you get a little bit more experience. That's absolutely fine. All right, that's absolutely fine. So that's our standard intro, because we want to reinforce best practice, good behaviors. Okay, that's what we want in new traders. But we want to talk about our main element here today, which is about really how do we train during the summer months. Summer months is a very different experience, but summer months is basically the period we find ourselves. And as I said at the start, I appreciate that we have a global audience here, all right, and that there's people join us from really four corners of the world, and it's fabulous. It's absolutely fantastic that you are able to join us here in Europe and North America. We are well into our what we would define as our calendar summer months. Although it's probably fair to say that we've all had maybe different experiences on the weather front. Some have had exceptionally hot, some have lots of rain. It depends upon where you are and how that has appeared. However, that kind of change in the seasons, and with it, that change in the weather, also has an impact on how markets perform and how traders, including yourself, will work during those periods. And it would be interesting to know from the traders here joining us here today what your own experience has been. Maybe you've not traded long enough to notice difference in seasons. Maybe you've noticed that over your years and you've got some experience. That's absolutely fine. It'd be interesting to know what, if any, experience you've had, if you've noticed any particular change. Because, as the slide says, new traders will be interested to know whether there are changes in markets based upon these seasons. So today, we'll take a little look at seasonality, how it affects markets, how it impacts kind of volatility, and actually how we can make best use of it, and make best use of those markets, but also our time during these particular summer months. So let's sort of talk about seasonality. And seasonality is defined very often as the study of markets in relation to the time of the year. That should be pretty self-explanatory, probably. Really, you don't really need a PhD to recognise that. In trading, there was always an old adage of sell in May and go away, and then I think it's do not return to St. Crispin's Day or St. But anyway, effectively it was sell in May and then go away and then basically not come back until end of August into September. That was, 50, well, in fact, I'd say probably 30, 50, 100 years ago, that was very much an adage in trading. And it's widely used in the stock market. And what happens is, during that period from like May to September, it would very often, we would see periods of low volatility within markets. And that starts to be something that you recognize or notice yourself. And by studying some of these historical moves, it's easy to see that there are clear patterns of seasonality playing a part in markets, and we're going to look at that a little bit more in the next couple of slides or two. So, well, what we tend to do is we like to break up the seasons and then group them into just very two simple categories that you can work with. We'll have a low season, which is between May and August, so we're in that at the moment, and then a high season between September to April. So, as I said, it was a bit of an old, stock market adage of sell in May and go away, and there is an element of that, but I personally believe that as we've moved across to global markets, electronic trading, okay, some people can trade from anywhere, any instrument, okay, that's what we have. That has changed a little bit, all right. And so I would say that May and June we still have good moves, good volatility, but as we come here into the sort of the latter half of July through August, okay, and into the sort of first, second week of September, that is more when we see, the kind of, it's almost like a season within the low season. It's it's the depth of winter in terms of trading activity and trading volatility. And so, what we look at is, how does that affect markets? All right, how does that affect our trading? What do we need to do? How do we need to take that into account in what we particularly do? And so let's have a little bit more of a look at that in terms of the specific instances. Because the reason is, as a master trader, it's imperative that you learn to identify these types of patterns, okay, and these types of periods of volatility in advance of your own particular trading. It's an element of learning the nuances and patterns of each currency pair that you plan to trade, and to keep a log of this information, as it can be truly priceless when trading. But as I said, I tend to find that from sort of kind of the second half of July through August into the first week of September, that can be, sort of, let's say a real low volatility period. And we'll look at in the moment and in the charts, how does that actually play out? What do you need to be aware of? What do you need to take on board when it comes to being able to sort of trade such particular periods? And what I would say is that it's a case of it goes across all instruments, right? And there's reasons for that, which we'll go into in a moment. But generally, during that particular period, it really does become a little bit low volatility. Markets spike a little bit more, and we'll talk about why that happens, and we're going to talk about, well, how do we need to adapt ourselves to that particular period. So let's take a little look at an example of seasonality and see how it impacts trading. So I'd just like you to have a little look at this. It's a chart of the pound against the US dollar. It's on the daily chart. And what we've done here is we've marked in the low seasons and marked in the high seasons of trade. Remember, we taught high seasons from about September through to April, and then low seasons from about May to end of August, start of September. So, when you look at that chart, ladies and gentlemen, can you see any particular patterns? Can you see any particular sort of patterns that stick out to you? Anything that really, when you look at that, think that your eyes, your cognitive recognition ability picks up on straight away? It would be interesting to see if you're able to see any particular patterns on there. Okay, and I appreciate that some of the people joining us are completely new to trade, and that's absolutely fine. There's never any such thing as a bad answer or a bad question. The whole idea is to be able to help educate you and give you insight into the ways that you can particularly operate. But it would be interesting to sort of see, when you look at that, what, if any, patterns that you may actually see with your own ideas, with your own mind, with your own sort of biases and prisms that you see on there. So in that kind of example, all right, which was, as I said, a daily chart of the pound against the US dollar, what I would hope that you'd have noticed that we were trending very strongly during the high season, and that we were predominantly ranging during the low season. Okay, just think about that. Let's just bring up this whole drawing tool here. Okay, and do that. So we had a high season here, and basically what we can see, hopefully, is during that period we were in pretty strong trend, weren't we? High season here the next year, okay, and we were in a pretty strong trend, weren't we? Okay, that's what we want to be able to see. Low season, well, actually, the market was predominantly ranging. Okay, it was just really maneuvering around here. Okay, during the low season, it topped before it sort of just rolled over. And during this low season, once again, we were just back to basically the price consolidating. Okay, so I'm hoping that you can actually see that. And if you think about it, if this was a currency that you traded a great deal of, do you think it would be useful to kind of know that information? Does that help you maybe look at charts with a little bit of a different view, okay, a different mind based upon what we've just looked at there? Okay, does that give you a little bit of food for thought, something that you can basically understand and take away and look for in the instruments that you trade? Because it might be a little bit different, but we generally tend to find, okay, that the high seasons, okay, and the low seasons, there is normally a difference in the way that those markets operate. And so, as I said, the answer should of course be clearly yes, that it is useful to kind of know this information. And it's true, you must understand the market you're trading before you can successfully implement a good trading strategy. This is all about context. As I said earlier on, very often new traders, they'll get focused on one little bit of, let's say, a hard skill. They want to, trade every engulfing candle they see. Okay, and it's a plan. But this is about the context. Okay, this is about the wider context that we want to understand, from which we have our look for patterns, and then we're looking for our particular trigger, context pattern trigger. That's the way we want to be able to. That's the way we want to be able to flow through. So I hope that gives you a little bit of insight, okay, and starts to give you a little bit of thinking about seasonality in terms of financial markets, because that then starts to lead us on to a very simple, what we call a very simple volatility table. All right, very simple volatility table, and that's what we're particularly looking for, right? And this, in particular, effectively what we're looking for is both on an intraday basis, but also as a swing trader. So if you think about it here, we've just talked about high seasons and we've just talked about low seasons. Okay, so we talked about that, about how that was effectively, September to April, and effectively, what we were looking for here was kind of, it's May to August is the low season. But what we also have, even within those seasons, we have zones. Okay, in terms of volatility, active zones, dead zones. So for me, trading, let's say the sterling pairs, okay, which is what I do an awful lot of in the FX work. For me, my active zone really is predominantly from about 8 o'clock in the morning, through to about 4 o'clock, okay, through to about 4 o'clock in the afternoon, okay, if I'm trading GBP. Okay, so if I'm trading GBP, that's it. And to be honest, most of my work is done in the morning. Okay, most of my work is done in that morning. The dead zone for something like me trading GBP, well, is when most of those protagonists have have finished the day. So really, I'm looking there, really on from about 4 o'clock through all the way through to almost like 8 o'clock next morning. That's not to say you can't trade then. Okay, you can't trade, let's say, pound against dollar, but you have to remember is that the after, let's say, for me, 8 o'clock, 9 o'clock in the evening through to sort of 6 o'clock, 7 o'clock next morning, that is to me is the dead zone. That's not to say there won't be some trading going on in the pound against the US dollar, but the majority of the main players, with people, sterling traders and dollar traders, they are no longer at the market. It's the same with if you are trading, let's say the DAX. Like, let's say you are an indices trader and you'd like to trade the DAX. Well, if you're like me, based in sort of Europe, the UK, you're really going to be looking at being interested in there around about sort of 7 o'clock, okay, 6, 7 o'clock in the morning through to perhaps about 4 o'clock in the afternoon. That is what I would call the active zone. Outside of that, okay, after about, for me, 4 o'clock in the afternoon, that becomes a bit of a dead zone in the DAX, right? Because basically, the majority of the trading goes on in the DAX in the morning, and in the afternoon it tends to just follow the US indices. If you're a trader of the US indices, okay, if you're the trader of the US indices, so invariably, for me here, if we're trading the US indices, that means, for my timings, okay, that means I'm looking around from around about 1 o'clock in the afternoon, realistically for about 3-4 hours, okay, and then you could say all the way up till about 9 o'clock in the evening UK time. That would be different based upon where you are, because that's when the main open times are of those US indices, 9:30 in the morning Eastern US time. Okay, outside of that, that is predominantly a dead zone. So what we need to start to do is to start to put together an understanding that ideally, okay, when we are trading, an instrument that is in its active zone and in its high season, well, the kind of trading styles that we would be particularly looking at are going to be things like trend trades. They're going to be momentum trades. This is where breakouts would be good. This is where you will normally see fast moves in the direction of the dominant trend. So ideally, it might be time for you to have a little look at, the instruments that you trade. Are you trading them in the active zone? All right. And as I said, I appreciate we have a global audience. You might be trading, let's say, maybe you're trading the DAX because, you've watched a few YouTube clips, you've seen a couple of my colleagues talking about trading DAX, and you've decided to trade the DAX. But it might be that you're based in Singapore or Bali or what have you, and actually, when it's suitable for you to trade in your, let's say, your morning, is a dead zone in the DAX. So actually, even though the instrument might appeal to you because what you see elsewhere, based upon your personal circumstances, that instrument is a dead zone, all right? And so you'd actually probably be better changing your focus towards a instrument that is presently in the active zone and the high season for where you are in the world, whether you be in Alaska, okay, whether you be in Brazil, whether you be in South Africa, okay, whether you be in London, whether you be in Dubai, whether you be in Bangkok, okay, wherever you are in the world, what you want to do is just to work out, okay, for your trading time, your specific trading time, which instruments are in their active zone and their high season, because those are the ones that are probably going to move in terms of trends, momentums, breakouts, fast moves that you can actually make use of. Because trade instruments that are effectively in things like their low season and also in their dead zone, well, not unsurprisingly, the kind of trading methods that are going to suit them are elements like range-bound trading, okay, trading between ranges, fade trades, okay, whereas effectively you're looking for false breakouts, okay, fade trades, fake breaks, and invariably slow moves. So when you're in active zones and high season, breakouts tend to work well. When you're in dead zones and low seasons, well, breakouts tend not to follow through. So things like fading trades, things like false breakouts, right? Those are particularly, the sort of kind of the trading setups we want to look at. So, it might be worth just taking a moment to think about how you trade at the moment, okay? How you think about trade at the moment. Does the way you trade at the moment, are the instruments that you're trading, do they suit, okay? Are you suiting, trading trends for instruments that are in high season and active zone? Like trading false breakouts. Okay, maybe you like trading false breakouts. That's I personally, on an intraday basis, I do like to trade false breakouts. But what I know is that there are certain times, okay, and certain instruments that I will look for those on, because ideally you're looking for trades, that are in their kind of dead zones, all right, or that are in their low seasons. So it is worth taking time to understand this volatility table, and also to be able to understand how to place that in the context of seasonality in general. So, we are going into a low season. We're in the low season, but we're into the low of the low season. That's what we'll be seeing soon. But also recognizing, if you're trading dead zones in a low season, well, you are unlikely to get long, strong trends. Okay, you're unlikely to get, follow throughs on moves. What's more likely to happen is markets are just going to be in ranges. They're just going to have lots of false breakouts, and even when they do move, it'll be a slow grinding move rather than a fast, quick move. So I hope that gives you a little bit of insight. I hope that gives you a little bit of food for thought. I hope that gives you just some context, all right? Some context within which you can start to sort of look at these particular markets, just look at your instrument, but also look at where you are trading from in the world, okay? As I said, you could be trading in Alaska, you could be trading in, in Bali, okay? All right. I know which one I'd prefer to be trading from, but there you go. We all have our own particular personal choices. But what I mean is understanding, where am I in the world? Okay, is the instrument am I trading? Am I trading it in its active zone and its high season? That's where ideally I want to be, especially if I want to be a trend trader, right? If I want to trade, momentums and breakouts, well, that's where I want to focus my time, energy, and resources. Okay, and in these summer months, all right, some months for us in Europe and North America, it's a case of we are going into low seasons. All right, low seasons, and to trade low season dead zones is like trying to run through mud. Okay, it's not particularly easy at all. So hopefully you can understand that seasonality will definitely play a part in certainly in a currency's volatility, but also generally in markets in particular. So it becomes important to learn to study the currencies you're trading. If you're like me, you're like an FX trader, but really for any instrument that you engage with. So as a little exercise, take any currency you intend to trade and then separate the seasons like I did in that previous example. Just look back for the last couple of years, all right, and start with the FX majors and just go through and start to identify where those high seasons, where those low seasons, what was the price action like? So, this was euro against the US dollar the last couple of years. This was the low season. I've just put grey boxes around the low season there. Okay, grey boxes around the low season. Can you see what the markets were like in those low seasons compared to what they were like in their high seasons? We had trends. Okay, we had trends. Then we had clear trends. Okay, clear trends that lasted at least a couple of months, sometimes 6 months, sometimes 8 months. But during our low season, you can see prices pretty much went sideways, didn't they? Pretty much went sideways there in the euro dollar. And as I say, that is not to say you can't trade during those periods. You just need to be aware of the changes due to seasonality, and you just need to be able to adapt your trading style, okay, to that. So if you are a committed trend trader, something that you just, that's what you live for, that's what you focus on. But you have to realize that, any trends you get during the low season are likely to be very short. Okay, they're not likely to follow through for months on end. Okay, you might get a week or two at best, and that's it. And so you have to just adapt to that. You adapt in terms of maybe how much you risk. You adapt in terms of how far your targets are away. You adapt in terms of what has to happen for you to basically to exit a trade. That might actually change a little bit. Okay, so these are the simple things that taking the time to look at now can actually help you, just have a better playbook during these particular seasons. So, as I kind of sort of said there, when you're trading in the low season, you must understand that you can trade trends, okay, as I was saying, that they tend not to last as long, they tend not to be as strong, they tend to kind of mean revert at the end quite easily. And so it's important, you need to be aware of key support and resistance levels on those higher timeframes, as the market is likely to falter there. Those levels of support resistance, they take on more strength during low seasons, right? Because there is a kind of fewer traders doing that, all right? And those low seasons are, lots of those big institutional traders, big hedge fund traders, this is when they are taking their holidays. This is when they're enjoying taking their private yacht to the south of France and stuff. And why wouldn't they? Okay, but invariably, what that means is they are not there putting through the kind of size of orders, the size of business in markets that they would be normally. And because there isn't the size of business, because there isn't the follow through on that, hence why we see ranges decrease. Okay, in terms of trading ranges, it's why we start to see volatility spikes. Okay, so a piece of news comes out, market will spike up, but actually it will revert to the mean, revert back into the range normally very, very quickly. Okay, and it is just as it says there. You have to recognise there is a good chance the market will fall into a range. Okay, it can run up to a level of resistance or down to a level of support, but then invariably what might happen is that it turns into a range in that particular area. And so it's important for you to just take that on board, how to understand that, build that in. It doesn't it's not. Doesn't take much time. Okay, it's not particularly difficult. It's just about building this. And this, as I said, this is all part of the kind of the soft skills that new traders don't realize they need. But as you trade, the longer you trade, the more you'll realize this is all part of you becoming a good operator in markets. This is all about the elements of you building the best trading in business you possibly can. So, further observations is that, the high season provides longer, stronger trends. Okay, so you can use the similar methods, but you're less worried about the general market direction because basically we tend to sort of trend stronger. What is relevant to you, okay, and what I do kind of sort of embolden is that it's more risky to trade against the major trend during the high season, as those trends tend to be longer and stronger. All right, so I appreciate if you're somebody who likes to trade reversals, if you're like someone who likes to pick tops and bottoms, you are going to struggle more when you're trying to trade against trends in high season, because those trends will move, they'll last for longer, they'll be stronger, they'll move further. All right, so fighting that is actually generally a pretty foolish endeavor. All right, far better to understand it and work with it. So one of those key differences between high season and low season is it's the length of the trend. All right, okay, the length of the trend. And so you should want to be aware of the possible reversal points during the low season. That's why, when I'm doing my own analysis or I'm in a trend, okay, if I'm in a trend that I'm looking for to move, I'm always aware of in future me, right? Where are these particular levels where the market has to make a decision? Okay, where are these decision points? Because I know that in low season, the likelihood is that the price actually might just falter there. The trend may falter, the trend may reverse and just come back into the range. So, I want to be looking in front of myself saying, well, these are areas, these are levels where the market's going to have to make a decision. And I want to be ready to sort of just to manage my position accordingly when I'm seeing that going on during the session. So, what you'll often see is high season will often consolidate, but then it will continue in the same direction. Okay, and that's what we'll quite often see. So, this is pound against the US dollar. This is the weekly chart. Once again, I just basically looked at the just grayed out the sort of the low season then, and hopefully you can see that basically just during that kind of low season, the price was just effectively going sideways, wasn't it? Just going sideways, very range bound there in the week. We'd already topped out, in the high season, our trend had topped out. And then actually what happened was we basically, as we went into the next high season, we just started to get into a strong trend. And then the low season wasn't a reversal. The low season just period consolidated before we moved down last year. That's what we looked at. Okay. And then we had another strong trend up from that. So I'm hoping you just, we've just looked at euro dollar. We can have a look at pound against US dollar here. Just recognizing that when you're looking at the big trends, it's about recognizing those periods. Okay. Just being on top of it and understanding that and adapting in the same way that a good tennis player adapts to the surface that they're on and the opposition they have, in the same way a good general adapts to the battlefield and the enemy they're on. It's the way as a good trader adapts, okay, to the market that they find themselves in. If they are trading active zones in high seasons, they know how to operate. If they're trying to trade dead zones in low seasons, well then once again, if they are trying to trade it, they'll know how to do it. But if they're smart, they probably won't, they won't actually try and go into that sort of minefield of being trapped in such areas. So, how do we use these observations for our own trading during summer months? Well, firstly, you have to accept, that you're in a low season, all right? And as I've just been saying there, you have to accept that trends will not be as strong or as long as they are in a high season. What you will find on an intraday basis, especially around news, is that there will be more volatility spikes, okay, where basically the price might have just been going sideways, but then it may spike up, okay, on the back of news because there's no let's say there's no counterparties, for want of a better word, to basically to measure that move. But then what actually does happen is that there is no follow through, and then price will just fall back within the range, okay. And you can see that quite a lot. This is a 30-minute chart of the pound against the US dollar, okay, so end of July time. You can see that basically price in the Asian session there just very, very quiet. Price pops up, all right, okay, but it fails to follow through and it comes back into the range, goes sideways, okay, over the lunch period, drops down, all right, okay, drops down, all right, in the session, but then comes back up and just comes back into that particular range, and that's what you see. Now, in many ways, those in themselves are tradable patterns on an intraday basis. But you need to, as I said, you need to understand what you're letting yourself in for. You need to adapt your plans, okay, accordingly. If you're buying breakouts, let's just clear this down. If you're buying, if you're looking to be a breakout trader and you buy the breakout, well, once prices moved, you're probably expecting it to basically to pull back and then continue. But it's not likely to, because it's likely to just revert back into the range when we're in the low season. There isn't the follow through. The major big players are no longer there to basically add to the position, okay, and give it the kind of momentum, the oomph to carry on moving. That will not happen. So you just need to think on ahead and just be aware of that. Just ready for that particular style of operating. So, as I said, you'll be more volatility spikes, followed by a reversion back into the range. That's what you expect, and and if you know that, well, then you can adapt your trading tactics accordingly. So yeah, I think this is from last summer. Yeah, there was just examples of volatility spikes in terms of this was pound against dollar again. Once then, which price is for the most part just pondering around in a range, then there might be some news or there might be a big order comes in and price actually spikes up. But then actually you can see it spikes all the way down and then price comes back up and really it kind of exits the day in the sort of same range that it was the next day. Okay, basically just as you can see, it was just in a small tight range. Okay, until in the afternoon. That's probably a piece of news, and actually price just spiked its way down. And it did pull back, it didn't pull all the way back into the range, but there was just a big spike. And I know lots of new traders will look at that and think, well, that's great, Paul. I want to be on those spikes. But the thing about volatility spikes is, they are fabulous when you're on the right side of it, but they can be very challenging when you're on the wrong side of it. And there's nothing to say why you would be on the right or the wrong side. Okay, it's one of the reasons why you have to just have your wits about you during the low season. You have to always make sure that you're managing risk accordingly, because you just need to be aware that such volatility spikes will occur. They can happen, and that can cause all sorts of issues. So you just want to be aware of that and act accordingly. So, in conclusion, before we just look at the live charts, we now know that price action is all about analysing markets using purely price movement over time, because we're looking for significant price action triggers at prices, levels, and zones, and that allows us to build a simple trading plan. But I think hopefully in this session, what we've realised is it's important for a trader to understand the impact of seasonality on markets and how they trade and how you should trade. It's helpful to use historical seasonality patterns to give you an edge in your market analysis to understand, am I trading active zones in high season, which is where I really want to be, because I need to, if I want to be a trend trader, or, am I trading dead zones in low seasons? Because that is always going to be, our market's always going to be like moving like treacle, all right? There's always going to be a difficult element to deal with. So remember, every currency acts differently. So you want to spend a little bit of time, okay? Be aware of your chosen market's behavior. Take the time to work out. Just go through the last few years, okay? It doesn't take very long, and a couple of your favorite instruments, and identify where the high seasons were, where the low seasons were, what was the price action like, what actually happened. Did we get really nice, good, strong trends in the high season and periods of consolidation, all right, during the low season? Just mark that out. Just look at it. Just get yourself ready to deal with that. As it says, learn to observe, and learn from historical moves as they will very often repeat. So before we switch across to the charts, just remember, join us next time, which will be next Wednesday, 2nd of August. Next session, what we're going to do is we're going to talk about how to combine price action and intraday trading, part 2. We did a session on it, or another session on it, a while back. And so we'll do a little recap of part 1. And then we're going to add in a few more elements, okay, with regards to price action and intraday trading markets, how to best utilize price action for your own intraday trading. So that'll be next Wednesday, 2 o'clock London time, 2nd of August. Check your inbox for the webinar link, or head over to the website to basically to allow you to register for those live webinars. And if you've got any questions, you can see that, with the email addresses there. And also, as I say, be sure to watch not only this, but our previous sessions and my other colleagues' work on the Admirals Global YouTube channel or on Facebook as well. So we've got a minute or two left. So let's just, why don't we just switch across to the charts and just see what's been going on there. So just bear with me a moment, ladies and gentlemen, and we'll do that. Let's go, just bang. Let's want that to be okay. Let's just pull this up. We're on the Admirals platform, but why don't we just have a little look here? Bring this up, see how this see how it loads up. We get so many things running today, so many elements, but let's just pull this up. Got a couple of charts up here that we can work with. Bring up, come on. It's gone very slow there this afternoon, hasn't it? There we go. So, we looked at the euro dollar there, okay, the weekly chart in terms of just looking at the price action, how it plays. Let's just have a look at something else like Aussie dollar. Let's just get rid of some of these indicators on here. Just give us a little bit more space. We'll go to the weekly chart, zoom out there. Okay, so bang. So yeah, so I'm just going to put in some, here we go. So, we had, the low season last year in Aussie against the US, all the 2 years before that. Let's just see where we were here. I might need to just adapt that bit so to, yeah. So there we go. Well, so just looking at Aussie dollar, we can just look at that for the last couple of years. Okay, we're just getting into it now. We can see, where you're getting into it now. But for the last couple of years, all right, it has mostly been in that particular case. The range isn't big. It was continuing the trend, but we can see that once we came back in, we can see that the moves start to pick up in terms of their pace. And the same here for the summer beforehand. Okay, price was just basically having, it topped out. We've had this huge, big bearish key reversal. I remember saying, I like a key reversal. Okay, they're at the end of a trend, and price basically triple topped, and we just basically continued in our sort of down journey, just basically Aussie weakness, dollar strength. But we want to be able to recognize what's that price action like during that particular window, during that particular period of low season. All right, and if we look at that, where are we going here? That's into August here. Let's just. There we go. I'm just going to take a little bit wider there. Just looking at that. Just 1 second. Hopefully, bang. Okay, thanks, Raquel. So, yeah, I was just showing that basically what we're looking at is Aussie against US dollar on the weekly chart, and how effectively that we had price had topped. Here we go. Price had topped out, been in a big uptrend, big bearish key reverse there, always like that, which then became a double top, and then basically we had a summer period there where yes, we were drifting down, but for the most part it was very quiet and slow. And then basically the next year, last year, okay, the summer low season period was, we had a little bit of a move, but you can see that the trend really picked up. The trend picked up before, and the trend picked up after those kind of those summer season, summer months low season. That's what we're really sort of just trying to identify and particularly work with. Okay, so if we look at that on the daily chart, okay, we had was that kind of mid-August, we had a little bit of a drop and a spike, didn't we? Then follow with a morning star formation before we came back into the range. But you can see for a lot of the period there, we were just really just in sideways blocks. Okay, and as I said, as an intraday trader, that can be, they can be traded even as a swing trader, that with a little bit of nous, but there was no follow throughs. Okay, and price, you can see the kind of levels of support and resistance. They went from being supports to being resistance. Okay, we had a kind of last bit of August, had a little bit of a flop there, okay, but it dropped out of it and it came right back up into that range, or right back up into that area there. And this is what this is what we just want to be we want to be aware of. And yeah, for the kind of here we go, for the summer afterwards and stuff, we were a little bit bang. If we just look at that, you can see that there was a move there, okay, but there wasn't any real conviction there, okay. It was just basically price was wrapped up for a lot of the time. Here we go. If you look, price was wrapped up with the moving averages for a lot of the time, a lot of that period. That in itself is a great indication when you're seeing that price and the moving averages all wrapped up, all rolled together. There's an indication that the volatility has died, okay. The moves have kind of have stopped occurring. And it was actually only after we came back into September that we started to get stronger moves occurring. So yeah, so that was just a random example. And as I said, you want to spend just a couple of times just going through your favorite instruments, just trying to identify high season, low season, because these are things that will actually help you as you start to build a picture of the broader context. Okay, so There we are, ladies and gentlemen. Unfortunately, we've kind of run out of time there as always. I hope that's just provided you with just a little bit of insight, okay? A little bit of insight into understanding seasonality, understanding volatility, understanding how markets operate during summer months, and actually what we have to do to be able to sort of just operate in those particular areas. If you're going to trade through those periods, there are ways that you just have to adapt, okay, to recognizing that markets, there will be volatility spikes. Markets will then revert back into the range most parts. If there are trends, those trends will not be as strong. They will not be as long as they are during high season. So you just need to adapt your trading tactics accordingly. So, as always, just wanted to say thank you for joining us. I hope you have a fabulous trading week, ladies and gentlemen. I wish you the best of success in your own trading endeavours. I hope you'll be joining us next week, okay, for Wednesday session, when we will look at go back into looking to intraday price action, okay, in terms of how intraday markets and price action, how you can work there together. So Raquel says, much appreciated, more aware of how to trade in these conditions. Yep, you're very well, Raquel. Thank you for the feedback. Hopefully it'll help. And as I said, it's all part of you developing and evolving as a trader. So have a great trading week, and I will speak to you soon, traders. Take care. Cheers.